Welcome back, everyone. Today on the Joseph Carlson Show, the market's in the green. It's doing well today. In fact, it seems like almost every stock is in the green. We have the NASDAQ up 1%, the S&P 500's up 1%, and even the Dow Jones is up 1.3%. So green across the board, except for maybe one company. One company in particular, which is, of course, Google. Google has not done well recently. I don't know if you've been following the stock price closely of Google, but it has not kept up with the rest of the market. In fact, if we just take a look here, we have the S&P 500 up around 10% this year, the same with the QQQ, and then we have Google up 7.6%. So it's underperformed the market year to date, which is interesting in and of itself because Google's a big tech company. It's supposed to be leading the market. Not only that, Google has also gone down from $192 per share. So right here, it was 193, 192, and it's gone all the way down to the 150s. So we have a price decrease of 22% over the past couple of months. 22% in Google. A 22% decline in a stock is not just a correction, this is a bear market. Google stock has entered into a bear market as the rest of the stock market surging upwards. So what's going on with Google? Why is the stock trading so cheap and it's still continuing to trade down? It's at a 17 forward PE ratio. While the market's going up, this stock continues to go down. We have a note here from Qualtrim saying that Alphabet shares are trading lower after the UK's CMA raised objections to the ad tech practices for Google. That's one piece of news. Of course, we can dive into this blockbuster antitrust case that's just risen again. So they have that going on. We also have news that Google may be losing its verb status. The Gen Z folk, the new kids, they're now saying search instead of Google. So we have a whole article here dedicated to Google losing its status as a verb. But I don't think these are the only reasons. I think there's more going on with Google that we'll be looking at today. So we're going to be diving in this episode to the reason that Google's going down in stock price. When we look over all the data, this is what's causing it to go down and what I believe will cause it to make a full recovery. My prediction is Google will eventually make a full recovery. And in fact, within a year, I see it trading above 190 once again. I'll be going over the reasons why. Apple, of course, has their new iPhone event where they went over all their new iPhones, all the new features, everything that they're showing for the future. Is this enough to cause a new upgrade cycle? Is Apple going to be able to accomplish that mission of causing people to once again ditch their old iPhones and buy the new ones? We'll see. And then finally, the Wall Street Journal got its hands on some leaked Disney data that reveals some financial metrics and KPIs and some strategies and secrets from Disney. So we're going to take a look at some of the specific numbers, like how much Disney Plus actually makes or loses. This is interesting data, so we'll be looking at that as well. So we have a lot to get into in this episode. All of this, of course, for free. If you like this type of content, just make sure to like the video and subscribe to the channel. Now let's go ahead and start off by talking about Google here. Google's trading down today 1.3% while the rest of the market races up. And that makes a difference. When you see this going on, where the Dow Jones is up 1.4%, the S&P 500 is up and the NASDAQ's up, and your stock going down, there's something specific going on because you can't explain this just by general market sentiment or by money flows, by equity flows. This means that people are penalizing Google. The difference in performance today is over 2%, meaning that on an average day where the market's flat, this is as if Google's down 2.3%. So this is a really red day for Google after previously, as of market close Friday, it had another very red day. It was down 3% on Friday alone. So Google shares are getting shredded right now. If we look at the biggest single factor impacting Google today, it's the antitrust lawsuits. It's regulation. If you recall, if we refresh your memory here just for a minute, Google just went through an antitrust case that they lost. That's the one where the Department of Justice sued Google for being an illegal monopoly, specifically by defaulting everywhere. So they bought defaults on, of course, Android and Mozilla and on Safari. Apple's was the big default. And basically, when Google's defaulted everywhere, they insulated themselves from competition. That was the argument from the Department of Justice, and they won that case. We don't see right now what the penalty could be. So potentially, Google could be broken up. That's one of the penalties that's on the table. Well, now we have a new one. This is round two. This is a completely different antitrust regulation or antitrust lawsuit being thrown at Google. And this time, it doesn't have to do with search being defaulted. This time it has to do with their ad place market. So Google has not only one monopoly in defaulting search, but now they're suggesting they have another one with their control over the ad market. If we read over the details of this new case, they say that the Justice Department's case is alleging that Google has an unlawful grip on the market of software being used to sell digital ads known as ad tech. When you go through the details here, they're suggesting that Google is on two different sides of this market. For example, Google owns the market, but then they're also competing in the market. They're buying and selling ads. And the Justice Department doesn't like that they both own it and compete in it. They're suggesting that it's unfair and in fact illegal. The Justice Department has said that Google, quote, has engaged in a campaign to condition, control, and tax digital advertisement transactions over 15 years. They say that this campaign was exclusionary, anti-competitive, and mutually reinforcing. Google has said in response to this, in preparation for this lawsuit, that, quote, we will show that ad buyers and sellers have many options. And when they choose Google, they do so because our ad tech is simple, affordable, effective, and in short, it works. So you get the basic summary of this new case. They're now not only a monopoly for defaulting their search engine, they're also a monopoly for having really good ad tech that everyone's using. So now Google's trying to defend two different monopolies, or so-called monopolies. And you can argue the nuance and differences between these monopolies and whether Google is truly a monopoly or not, but that's an argument for a different day. When it comes down to it, we're investors. We're looking for where we can make money. And the question is whether or not Google's going to recover with all these lawsuits going on. Can Google not only persevere through all this regulation, but ultimately prevail and become even more prosperous in the future? We need to know whether or not this company can make a full recovery, whether or not the stock price will go back up to $200. And my argument today is going to be that they will. I think that ultimately, I believe all the unknowns, all the uncertainties today will be looked back on as a buying opportunity. I believe that Google will eventually recover because when we look at these type of headlines, the Department of Justice launching another lawsuit, these big, bold, glaring headlines, that creates an emotional reaction in Google shareholders. It causes people to want to sell the stock. And ultimately, a lot of investors look at these headlines over focusing on the fundamentals. And I've seen this time and time again with Google. If we look at the actual company and the actual fundamentals, we get a much better idea of what's going on with this company. And most of the fundamentals, the actual cold, hard data, shows that Google's in a much better situation and a much better position than what the headlines would lead you to believe. For example, we can look at the fears surrounding Google search. If we cross out all other forms of revenue, except for just Google search, we see the growth trajectory over time. You've been told to be scared about Google search, that there's GPT search, there's Perplexity, there's Bing AI. There's now articles from Business Insider that Google's not even a verb anymore. People are just saying to search things instead of to Google them. But during all of that, all those scary headlines, Google search has grown 14% year over year. The revenue continues to grow. People are still using Google search. Despite all the headlines you see, the data shows continued growth as of this most recent quarter. It's not even slowing down in the most recent quarter. We can take a look at YouTube, for example. YouTube continues to grow, and of course it does. Everyone you know uses YouTube. You look at Google Network. This is the part of the business that they're suggesting is a monopoly for Google, and ironically, this is the only part that's actually shrinking year over year. So the Department of Justice is late to the game. They're targeting a portion of the company that is not even growing. We look at the subscription business. This is a YouTube subscription, YouTube Premium. This grew 14%. So we see good growth there as well. We look at Google Cloud, which I'll go into as the most interesting, important, and intrinsic growth path for Google. And this is growing like crazy. It grew 28% year over year as of the most recent quarter. So the most important part of Google's business is growing nearly 30% year over year. When I look over the revenue by segment, I don't see anything to suggest panic. So in the revenue line items, I don't see a problem with Google. Now, there is some concerns about different financial metrics of Google, specifically the free cash flow of the company. If we look at my investment philosophy and the biggest drivers of intrinsic value meaning the value of the stock, what the stock price will trade up to, I define the biggest drivers of intrinsic value as three separate things. One of them being organic revenue growth. This is revenue growth just through price increases or more customers, more volume, not revenue growth through doing dilutive acquisitions or buying things with debt. So organic revenue growth is a main driver of intrinsic value. Another one is free cash flow per share growth. When free cash flow per share starts to grow, typically the intrinsic value of a company is going up. And then the last one is the predictability improving. Predictability improving means that the company is becoming more predictable, the moat is expanding, the durability and predictability of the company is improving. When we look at Google, they're missing a couple of these. First of all, as we've already outlined, the predictability is not really improving. If anything, the predictability is getting a little worse as we have all these recent lawsuits. Now, the predictability will improve once these lawsuits are unsettled, once we know whether or not Google's being broken up. Once we can get all these big question marks behind us, predictability improves, and so does the intrinsic value. But the other one that we could look at is the free cash flow per share. Now we have the free cash flow here on a trailing 12-month basis. This shows you it not on a per share basis, but just on a total nominal basis. Google, over the last 12 months, generated $60.7 billion in free cash flow. When we look at this with a stock-based comp view, we know that they have a lot of dilution here. So they're diluting a lot to pay all of this talent, all of these engineers at their company. When we break this down further on a free cash flow per share basis, you can see the issue here. When I zoom in to the past 10 years, you can see it clearer. Google's stock price goes up when the free cash flow per share goes up. From 2019 to 2021, the free cash flow per share went from $2 to $5. Let's go ahead and take a look at the stock price. We can go back 10 years here. From 2019 to 2021, the stock price went from $62, $65 to $140. The free cash flow per share doubled over this time period. The stock price doubled. Very simple. We go back to the free cash flow per share and we take a look at what's happened since 2021. You can see it very clearly here. I can draw a line. The free cash flow per share has been entirely flat since 2021. It was $5.19. The most recent quarter on a trailing basis, it was $4.87. So it's about the same. It's around $5 per share in free cash flow. Then we go back to the price chart here. We can take a look again. Where is the price since 2021? The price is completely flat. The free cash flow per share is flat. The price is flat. Very simple math. Remember, a company needs to have these three things to have the stock price increase in any meaningful or sustainable amount. We have organic revenue growth. So we have one ingredient here, but we do not have the predictability improving. Google's predictability has been ebbing and flowing. I would say it's been going down a little bit. And we also have free cash flow per share not growing, but it's just staying the same. So the stock price ultimately is staying around the same. So the formula here is very simple. For Google's stock price to go back up to $190 or above $200 per share, the free cash flow per share needs to go back up and the predictability needs to improve a little. We need the lawsuits and the uncertainty to get further behind us. Once we get a little bit more clarity, predictability improves and that helps the stock price out. And then ultimately the free cash flow needs to go back up. Now, how does Google's free cash flow go back up? Well, the formula here is very simple again. So you take the operating income of the company and you subtract out the CapEx expenditure. Now, the problem is, as Google has been earning more and more in operating income, they've also been increasing the amount of CapEx. So the free cash flow is not growing in line with their operating income. To illustrate this, we can take a look at their expenses. We go down to expenses here. We filter by the CapEx, and we can see the enormous expansion of CapEx. It's going up like crazy. The most recent quarter, Google has spent $44 billion in CapEx over the trailing 12 months. So in the full trailing year, they've spent $45 billion in CapEx. That is incredible. That's a company that's no longer capital light or highly efficient. This is a company that takes significant investments to run. So even though they're growing in their operating income, they're earning more money organically, they're throwing a huge portion of that money back into CapEx. So the reason the free cash flow per share has been trending down for Google for the past 4 quarters is because the CapEx has been trending dramatically up for the past 4 quarters. And that leaves me with a couple questions. First of all, the biggest question is, what is all this CapEx for? And are they going to get really high returns on it? Because I don't mind Google spending an enormous amount on CapEx if they're going to get really good returns. If they get a high return on capital employed and all these investments pay off, this money's well spent. So what is all this CapEx being used for? The biggest hint that Google gave us was in their earnings call. They spoke directly about the CapEx. If we bring up their recent earnings reports here, their earnings transcripts, and we bring up Q2, this is the most recent one, we can search this page and just search CapEx. And this brings us right to it. With respect to CapEx, our reported CapEx in the second quarter was 13 billion. Once again, driven overwhelmingly by investment in our technical infrastructure, with the largest component for servers, followed by data centers. Looking ahead, we continue to expect quarterly CapEx throughout the year to be roughly at or above Q1 CapEx of 12 billion, keeping in mind that the timing of cash payments can cause variability in quarter reported CapEx. Google's spending all of this increase in CapEx on Google Cloud. And again, I believe that Google Cloud is the most meaningful, best part of Google as a business. Google Search is supporting the stock right now. It's the profit center for the company, but Google Cloud is the new growth path for this company. Google's in third place behind Azure and behind AWS, but it still has a very meaningful business. In the most recent quarter, it did $10 billion. So this is above a $40 billion run rate, growing 30%. On top of that growth, if we look at the ROI they're getting, the actual profits they're getting, it's now moved firmly into profit mode as well. For a long period of time, Google Cloud was losing money. This is the operating margins over time. So any chart going down means they're losing money. Now that they're going up means they're making money. This is now at 11%. I think these operating margins will continue to climb up to 30%. And this is happening while Google's making significant investments in their cloud infrastructure. And ultimately, when we look at the free cash flow and we hash out these questions of how much Google needs to spend or how much they're spending right now, I think ultimately the amount that they need to spend on technical infrastructure will slow down. The amount of CapEx needed to run this business will normalize over a period of time. You can see that throughout history, the CapEx requirements of Google go through these huge growth modes where they spend a lot more money, and then they stabilize, they normalize, and in some cases, they even go down a little bit. And if that happens again in the future, if we get through this huge CapEx investment cycle into cloud, and eventually it normalizes, it slows down, and it stabilizes, and Google continues to grow their revenue, then the free cash flow per share growth will follow. Instead of going down, it'll trend right back up. If we have that free cash flow per share growth, that'll be another intrinsic value driver for the company. The final one will be the predictability improving, which I believe will happen around the same time. I think over the next year or so, predictability is going to improve as we get ahead of these lawsuits, and the free cash flow per share growth will improve as the CapEx spend normalizes. So looking over Google and my position in the company, I'm still bullish on it. And in fact, if it continues to trade down like it is, I'll be adding to my position for the first time in well over a year. So this is a company that I'm making a bet on. I have around $32,000 invested in this one, so a significant portion in Google. But I wanted to share these thoughts because I think this company right now is a buy. Now moving on, we get to Apple's highly anticipated Apple event. And this is where they're supposed to reveal all new iPhones and other devices. In this one in particular, they said they're going to be talking about the Apple Watch, the AirPod, and the iPhone. Let me give a brief update of everything they went over in this event. First of all, they came out with a new Apple Watch Series 10 with a bigger screen and thinner design. They made it so that the Apple Watch Ultra 2 now comes in black. And they talked a lot about the Apple Band. So they have a brand new band, looks really stylish, it's all black. These are little iterative updates, but I guess if you're looking to get one, this might convince you. Another thing they talked about is that the Apple Watch can now detect sleep apnea. And this is the first thing they spoke about in terms of healthcare. I've said years and years now that Apple is a healthcare company, and they're going to become a bigger and bigger healthcare company. When you think of healthcare, you might think of pharmaceuticals, but that's not the only part of healthcare companies. There's many companies like Medtronic that make medical devices. Apple is now a medical device company. The Apple Watch is just another example of that. It literally can diagnose you with heart issues, and now it can diagnose you with sleep apnea. So these are good additions to Apple, and I think they're going to continue going down this route of healthcare. They also announced the Apple AirPod Max with USB-C charging, and it comes in all different colorways. I think that Apple, they do this strategy where if they don't have a lot of real changes to the product, if it's just like a difference in charging it, then they open up new colors. It's kind of their go-to. If we don't have some big groundbreaking change, let's offer a bunch of different colors, because colors are really important. Apple's a great marketing company. Apple also announced new AirPods, the AirPod 4s, that have noise cancellation and better sound. Now, of course, we know that Apple is going to be coming out with incremental updates in their AirPods because it's one of their most profitable, best-selling devices ever. But in this case, they also came out with a software upgrade for the AirPods that is a huge step. They have now a clinical-grade hearing test that you can perform with the AirPods on your iPhone. So you can simply put the AirPods in, do the hearing test, you tap if you hear a sound, you don't tap if you don't, and they can judge what your hearing is, if you have any hearing loss. Based on the hearing loss, they can also work as hearing aids. Now the Apple AirPods are like hearing aids to people that have hearing loss. And I think this is more meaningful than it looks. We know that hearing tests are easy to do. You can go to a local hearing clinic and get a hearing test. And you can also get hearing aids. Although they're very expensive, you can, in most cases, get those covered by insurance. So people don't have a lack of access to hearing aids or hearing tests. But yet they highlight that 80% of Americans have not gotten a hearing test in the past 5 years because most people don't want to deal with it. They don't want to deal with hearing aids. They have a stigma attached to them. So if you're wearing hearing aids and they wrap around your ear, people are going to be looking at that and there's a social stigma. With the Apple AirPods now acting as a clinical grade hearing aid, people that have some hearing loss could put them in, act as though they're just using their AirPods, but now they have better hearing. So it's a way of treating a hearing condition without dealing with the stigma associated with hearing loss. This is another big way that Apple's getting into healthcare. It's not just with the watch, now it's with the Airs. Now when we get to the iPhone, of course they announced the iPhone 16 with a faster processor. They went over the specs, and like Apple always does, it's so much faster than the previous version every single time. Most of us know about that. We know that every phone's going to be faster, so that's not the biggest takeaway. Apple needs to put in some other goodie, some other thing besides just a processor update in each of their phones, some reason to justify mentally buying the new phone. In this case, they went with a new button. They slapped a new button onto the right side of the phone, which is called the camera control button. Now, they really talk this up like it's this big deal, like a massive new innovation. The button has 2 different pads. It's easier to press. It has haptic feedback. It can be pressed halfway or all the way. It can be held down or double tapped. It's a really versatile button. So they did put a lot of energy into this button. I just don't think that this is enough to make the jump. I think it's a good addition. I actually think people really like having a dedicated camera control button, but it doesn't seem like this in and of itself is going to make a lot of people move from the iPhone 15 to the 16. It might be another goodie if you're all the way back on the 12 or 13. The biggest features that Apple released that will promote upgrades from one device to the next is not the hardware, but it's the software. It's the artificial intelligence. Apple has new visual intelligence that can actually look at the screen. It can look at what you're doing, and you can tell Siri to do certain things with what you're currently viewing. Not only can it look at the screen, but it can look through the camera, like the lens, the outdoors, and you can ask Siri questions based on that, or you can ask ChatGPT. So Apple is leveraging its massive platform to default all these different options of ChatGPT or Google to enhance Apple's platform. And this is what they spent a lot of time on. All the new hardware upgrades for Apple's new iPhones are specifically to allow for all the new AI capabilities, specifically the contextual awareness of Siri. Siri's not just like a random ChatGPT. Siri's going to know the context of everything on your device. And Apple emphasized over and over again that all of that context is private. It's on device. It's local. It's not stored anywhere where someone else can be peeking at your iPhone and what you're doing. So Siri has all the context of your text messages, your history, your journal entries, your notepad, your voice memos, your photos, and everything. Siri can filter through all sorts of historical data, can retrieve information. It's like having a personal executive assistant where you can say, hey, find me all those photos from this different trip and send it to this person, and Siri will do that for you. The contextual awareness of this new AI is the single biggest selling point of these new phones. So overall, the iPhone gets the most attention with these events, and I think it's true that AI and contextual awareness is a really big deal, but that was somewhat expected. The storyline that I think needs to get highlighted more with Apple is that this is becoming the biggest healthcare company in the world. They are now a medical device company. With the Apple Watch and the AirPods, they're becoming more medically enhanced. The Apple Watch is a fitness device, a heart rate monitor, a sleep apnea detector, and soon I think it will be a glucose monitor. The Apple AirPods are now hearing aids that are clinically proven to detect hearing loss. So all of their devices and peripherals are now becoming healthcare. So I think overall, when I look at this, I like the changes Apple's doing. I like the progress they're making. I don't think anything here was too groundbreaking. Overall, this was a solid event. I don't know if it's enough to spark a massive upgrade cycle, but I think it's enough to keep the stock where it currently is. Now moving on, we get to the news that Disney recently had a massive data leak. And in most cases, when a company has a big data leak, I don't think there's anything too interesting. Usually companies do share the best information publicly about the companies. They track them in public disclosures and KPIs. But in this case, Disney did leak a couple things that I thought were noteworthy. Disney Genie has become a massive profit center for the Disney park. If you recall, back in the day, Disney would allow you to get fast passes. That's what they were called. Then Disney decided to make an app and monetize the fast pass. They turned it into Disney Genie. The leaked files indicate that the passes generated more than $724 million in pre-tax revenue between October 2021 and June 2024. So this is the reason that they push Disney Genie so hard. They're making hundreds of millions of dollars from this one incremental change. I think that this is another way that Disney has nickel and dime people in the park, but it seems to be working. The other big revelation in this leaked report was the specific profitability of Disney Plus. Now, Disney releases their direct-to-consumer product line, and you see how much they make from direct-to-consumer, but they do not break it down from Disney Plus specifically. In this leaked report, we know that Disney Plus generated more than $2.4 billion in revenue in the March quarter. That amounts to around 43% of the revenue the company reports in its direct-to-consumer entertainment business. If we look at that and compare it to Netflix, we can see that Netflix in the last quarter generated $9.53 billion. So the Disney Plus streaming service is around a quarter of the size of Netflix currently. This shows us how far ahead Netflix actually is in the streaming business. Now, of course, there's more to this leaked document. There's how they handle different political events, as well as how they promote and compete against companies like Netflix. I looked through it, and there's not anything I thought was too interesting. So that's going to be it for this episode. If you like this type of content and you want to see more of it, we have a lot of exclusive content as part of the Patreon membership. You can sign up today risk-free. That's all for now. See you in the next one.